TechFinance Briefing, June 17, 2026. 5 Frontiers in Finance Revolution. Tomorrow's top fintech and market infrastructure stories, from digital cash hoards to risk guardians and around-the-clock exchanges. All information is news, not advice. Corporate treasurers embrace digital liquidity. CFOs deploy stablecoins to unlock trapped cash. Corporate treasury departments are venturing into a digital frontier once reserved for crypto enthusiasts. In a world where cash flow management is king, CFOs are turning to regulated stablecoins as a serious tool for liquidity and working capital, especially for cross-border transfers and after-hours needs. Once viewed with skepticism, these digital dollars have matured. The global supply of fiat-backed stablecoins has swollen beyond $270 billion, and annual transaction values surpassed $10 trillion in 2025. These once experimental assets are now helping companies manage cash 24/7, eliminating weekend gaps and enabling near-instant settlement of international invoices. As humankind reaches for the stars, corporate treasurers likewise explore new financial galaxies, banking on technology to transcend the gravity of legacy systems. Fintech Bloom. Behind the scenes, treasury technology is evolving from static spreadsheets to cloud-based, AI-powered platforms. Advanced cash forecasting algorithms sift through seas of financial data to predict future cash needs with uncanny precision, giving CFOs a sense of control akin to a navigator charting a ship by starlight. The payoff is real. Uninterrupted cash visibility and just-in-time funding decisions are saving millions by reducing idle balances and capturing higher yields as interest rates climb. The significance of stablecoins in corporate treasury operations is underscored by a wave of fintech investments, notably digital finance giant Ripple's $1 billion buyout of treasury management platform G-Treasury in late 2025 aimed to integrate blockchain networks into everyday treasury flows. With these innovations, CFOs can channel excess cash into short-term investments around the clock and deploy funds across borders in seconds, turning former dead capital into rocket fuel for growth. Ripple. Regulators have taken notice and are updating laws to accommodate this brave new financial world. The U.S. Genius Act, a landmark stablecoin regulation, and Europe's MiCA cryptoasset framework have provided clarity on how digital dollars can be legally held and used by corporates, removing a key barrier for risk-averse treasurers. Treasury teams, working closely with their legal counsel, are tightening internal controls to meet these rules and ensure that real-time digital moves don't expose companies to compliance pitfalls. Legal and accounting challenges remain, from navigating evolving tax treatments of digital assets to ensuring stablecoin reserves stay fully backed and transparent. Still, with pragmatic regulations unlocking innovation, global companies feel more confident exploring stablecoins and digital cash management. A new era of corporate treasury is dawning, one in which finance chiefs act not just as guardians of cash, but as pioneers of a multi-planetary economy's next-generation infrastructure, channeling resources with unprecedented speed and autonomy. Subtopic: Regulatory clarity like the US's stablecoin law and EU's MiCA makes it safer for treasurers to hold digital assets, integrating compliance into corporate liquidity strategies. Fintech Bloom. Enterprise risk strategies evolve. Boards brace for AI threats and unknown unknowns. The landscape of enterprise risk management is shifting beneath our feet as we march further into the digital age. In 2026, corporate risk officers face a panorama of complex challenges, geopolitical tensions reverberating through supply chains, surging cyber attacks, and the unpredictable side of artificial intelligence. A global risk survey confirms what many in boardrooms already sense. Cyber incidents are the #1 threat to businesses for the 5th year running, cited by 42% of executives as a top concern. Meanwhile, AI-related uncertainty has rocketed from a niche worry to the second highest risk in just 1 year. The rapid deployment of AI tools promises competitive gains, but also invites novel dangers, from autonomous decision-making glitches to ethical pitfalls and deepfake fraud. Today's risk managers are learning to think like mission controllers, training for crises before they happen and crafting contingency plans as if preparing for a space mission where unknown unknowns lurk beyond each horizon. Academy. As threats multiply, so do the tools to combat them. Forward-looking companies are weaving AI into their risk management defenses, using machine learning to detect anomalies and simulate worst-case scenarios. In the era of ubiquitous data breaches and ever-adaptive malware, traditional periodic audits or static spreadsheets seem as outdated as astrolabes on a spaceship. Organizations now conduct continuous stress tests on their operations and financial assumptions, scenario planning for everything from an AI algorithm gone rogue to a sudden geopolitical shock affecting global markets. Firms pioneering these approaches say it's like shielding a colony on Mars. You must engineer resilience into every system from day one. Data from industry think tanks indicates a surge in budgets for cybersecurity and operational risk management this year. Companies are recruiting chief risk officers and giving them equal standing with CFOs and CTOs to ensure decisions about growth come hand in hand with risk foresight. Academy. Regulators, too, are raising their expectations. In Europe, new rules like the Digital Operational Resilience Act, DORA, demand robust testing of banks' and fintech's tech defenses, effectively forcing companies to prove their resilience to digital disruptions under supervised conditions. Meanwhile, the UK's corporate law now includes a failure to prevent fraud offence, which is expected to lead to the first prosecutions in 2026, putting pressure on boards to have watertight anti-fraud controls in place. Across the Atlantic, U.S. regulators are revising guidance to encourage financial institutions to integrate AI oversight into their enterprise risk frameworks, knowing full well that algorithms can create as much risk as they remove. With the trust of stakeholders and even public safety on the line, frameworks are evolving to be more proactive, data-driven, and imaginative. In this dynamic environment, companies that treat risk as a living discipline, much like a crew that constantly monitors and adjusts its spaceship's course, are the ones navigating the turbulent skies most successfully. Subtopic: New legal frameworks like the UK's Failure to Prevent Fraud law and EU's digital resilience regulations require companies to tighten their risk and anti-fraud controls, merging compliance with strategic risk planning. Fintech Bloom.
Moody's.
B2B payments race goes real-time. Instant rails reshape global commerce. The world of B2B payments and financial infrastructure is accelerating to a real-time rhythm as businesses demand instant settlement and seamless global transactions. Just 2 years after launch, the U.S. Federal Reserve's FedNow Instant Payment Network has enrolled over 1,600 banks and credit unions, enabling companies across the country to send money in seconds around the clock. Transaction volumes on FedNow have exploded by 460% year-on-year, with daily payments up to 30,000 and values soaring into the hundreds of billions of dollars. This rapid adoption signals a tipping point. Real-time payments are transitioning from experimental pilot to everyday expectation. U.S. businesses, particularly those managing tight working capital cycles, are finding that paying suppliers and pulling in receivables within seconds, even at 3 a.m. on a Sunday, can dramatically improve cash flow and competitive agility. It's akin to commerce getting a hyperdrive upgrade. Supply chains no longer pause for bank wires to clear, and CFOs can navigate liquidity across time zones as smoothly as steering a spaceship on autopilot. Payment Journal. Fintech Bloom. Globally, other payment rails are also bolting ahead. Europe's newly enacted Instant Payments Regulation, IPR, is compelling every EU bank to offer lightning-fast euro transfers around the clock at low cost, closing the gap between traditional transfers and digital native expectations. By mandating instant euro payments as the norm, the EU is effectively ending the era of multi-day fund floats and giving a regulatory push to catch up with fintech speed. In Asia and Africa, super app platforms and mobile money networks are handling hundreds of millions of daily transactions, empowering small businesses in developing markets to join the digital economy with just a phone. Meanwhile, Decades-old cross-border payment corridors are being disrupted by blockchain solutions. Stablecoins have slashed remittance fees and times for global merchants and diaspora communities, undercutting costly correspondent banking. When Tether, issuer of the USD Mongolian Gurik stablecoin, invested in a startup focused on remittances to Africa and Asia, it underscored the rising confidence that corporate payments will increasingly ride on crypto rails. Even established giants are adapting. Visa's partnership enabling stablecoin settlements through its network and MasterCard's venture into stablecoin as a service reveal these incumbents view blockchain-based flows not as rivals, but as new plumbing in the global payments system. Fintech bloom. As infrastructure modernizes, regulators are ensuring the engines of commerce run safely at warp speed. Across markets, compliance and risk considerations are being built into the new B2B payment pipes. Central banks are stressing robust KYC/AML checks and fraud monitoring built into instant payment schemes, learning from early adopters to guard against scammers exploiting faster payouts. Laws like the US UCC amendments to formally recognize digital payments and standards under development at the Bank for International Settlements are shaping a consistent legal foundation for real-time payments so that businesses can trust these new rails. The optimists note that an era of truly inclusive global trade is emerging, where even a small vendor can receive payment immediately from across the world, unlocking working capital and opportunity. By adding a dash of futurism, imagine on-orbit marketplaces or lunar colonies one day settling invoices back on Earth through the same networks. These innovations reveal a hopeful trajectory, a planetary economy beating in real time, with finance moving at the speed of thought. Subtopic: in the legal realm, regulations like the EU's Instant Payments Law make near-instant transfers mandatory, standardizing real-time infrastructure and incentivizing businesses to adopt faster B2B payment solutions under safe regulatory oversight. Payment Journal. RegTech reaches for real-time compliance. AI watchdogs stand guard as rules tighten. In the regulatory technology, RegTech arena, financial institutions are upgrading their compliance systems as urgently as a spaceship crew bolstering life support before a long voyage. 2026 has brought a one-two punch of new regulatory frameworks on both sides of the Atlantic, forcing banks and fintechs to manage risks in real time. Europe's comprehensive MiCA law is now on the brink of full enforcement. By next month, any crypto asset service provider operating in the EU must secure a license or shut down, a deadline that has left compliance teams scrambling to ensure every digital asset product is by the book. Meanwhile, in the US, the newly enacted Genius Act on stablecoins has tightened federal oversight on digital dollar issuers, mandating rigorous KYC and reporting requirements akin to traditional banks. These developments highlight how regulators are serious about plugging gaps in the burgeoning digital finance landscape and how RegTech solutions, once a nice-to-have, have become mission-critical for any institution hoping to keep launching new services without legal turbulence. Fintech bloom.
Moody's.
The industry's response has been an arms race in innovation. Banks and startups are deploying machine learning systems that ingest thousands of pages of regulatory text the instant they are published and automatically map new rules to internal policies. In compliance departments, AI assistants are tirelessly monitoring transactions for anomalies 24/7, flagging potential money laundering or fraud in seconds where a human analyst might take days. It's a shift from retrospective reporting to continuous, autopilot compliance, a bit like having an AI co-pilot constantly scanning for asteroids and adjusting course to avoid them. The payoff is already evident. Fast-moving institutions that invested early in real-time RegTech now boast dramatically quicker customer onboarding because automated checks clear legitimate clients in minutes, not weeks. They also carry lower regulatory risk, catching problems before they spiral, and they earn goodwill from regulators for proactively safeguarding the financial system. The result: compliance is no longer seen merely as a cost center, but as strategic infrastructure, a competitive edge that determines which banks can safely scale their digital operations. Fintech bloom. Even the legal profession is adapting to this tech-forward compliance culture. Lawmakers drafting fintech rules are increasingly partnering with technology experts to ensure new laws can be interpreted by algorithms as easily as by attorneys. Regulatory agencies are piloting their own supervisory tech, ingesting massive datasets from firms to flag issues in real time rather than relying solely on periodic audits. This tighter integration between law and technology suggests a future where compliance is embedded and mostly invisible, where companies and regulators alike share something akin to a unified dashboard monitoring the financial galaxy for threats. It's a hopeful vision, a world in which consumer protections and market integrity are maintained not through after-the-fact penalties, but through intelligent systems that uphold the rules by default. Still, caution is warranted. Even the smartest AI can err, and final accountability remains with humans. As the regulatory perimeter extends to new digital domains, the marriage of regtech and law promises to keep innovation on course without sacrificing safety, balancing the boldness of exploration with the anchor of oversight. Subtopic: New fintech regulations like Europe's MiCA and the U.S. Stablecoin Act compel financial firms to implement advanced compliance technology to meet stricter KYC and real-time monitoring requirements, integrating legal obligations directly into tech systems. Fintech Bloom. +1. Market infrastructure enters the 24/7 era. Exchanges rocket toward around-the-clock trading. The final frontier of institutional trading and market infrastructure is time itself. In a dramatic shift, major stock exchanges and trading platforms around the world are moving to tear down the old barriers of opening and closing bells, aiming to keep markets buzzing nearly 24 hours a day, 5 days a week. Long considered a futuristic scenario, near-continuous trading is quickly becoming reality. U.S. regulators have already approved new exchanges that run from Sunday night through Friday evening on a 23/5 schedule. This year, NASDAQ and the New York Stock Exchange are seeking the green light to extend their trading sessions to essentially all but 1 hour of the day. By mid-2026, the industry's clearinghouse is preparing to support overnight trade settlements, aligning the back-end plumbing with these expanded hours. For institutional traders and asset managers, this means rethinking decades-old routines. No more waiting for Monday morning to react to a weekend geopolitical shock or central bank move. The market never sleeps now. It's as if Wall Street built its own space station where the sun never sets, requiring constant vigilance, but offering immense new possibilities for global investors. SIFMA. This transformation is fueled by technology and pressure from digital assets that trade relentlessly. Crypto markets taught the world that price discovery can happen around the clock, and now traditional finance is playing catch-up. The first adopters of extended hours are already reaping benefits. Some trading firms report improved risk management because they can rebalance positions or meet margin calls at any time, while exchanges see new revenue streams from catering to international investors across time zones. Trade volumes during overnight sessions remain modest, but even a fraction of regular hours activity can equate to tens of billions of dollars moving when once all was quiet. Moreover, the same technologies enabling continuous trading, like blockchain settlement networks and AI-driven market monitoring, are also slashing trade settlement times from days to minutes. On select platforms, tokenized securities and digital assets are settling nearly instantly, demonstrating how trading and post-trading are converging across a unified, high-speed digital rail. When every second can be a trading session and settlement is immediate, the line between day and night, or between trading and clearing, fades away. SIFMA. Horizon Rating. With the rush toward always-on markets comes a wave of structural and regulatory questions. Market operators and watchdogs are carefully calibrating new volatility controls to handle continuous trading, updated circuit breakers, liquidity buffers, and overnight supervision protocols to ensure that 3 a.m. price swings don't spiral out of control. The Securities and Exchange Commission is working through the implications for fair access and market stability as more exchanges join the 24/7 race, likely making extended hours a baseline service by late 2026. Internationally, Europe's experiments with blockchain-based trading venues under its DLT pilot regime point toward a future of integrated trading and settlement, though regulators urge caution over legal and technical hurdles before making such pilot programs permanent. For institutional investors prepared to operate in this new paradigm, the transformation means new strategies and technology to monitor markets and manage risk at all hours. But the overarching sentiment is one of enthusiasm. An always open market is seen as more inclusive and reflective of a truly global, connected economy where someone, somewhere is always awake and ready to trade. Just as humanity does not cease its endeavors when the Earth rotates out of sunlight, financial markets are joining the ranks of the always on, pushing the boundaries of how and when value can be exchanged. Subtopic: a regulatory shift accompanies this trend. U.S. and European authorities are adapting rules and pilot programs like the SEC's extended hours approvals and the EU's DLT market sandbox to enable near 24/7 trading, ensuring market stability while fostering innovation in trading infrastructure. SIFMA. Goodwin Law. Disclaimer: this forward-looking report is for informational purposes only and does not constitute legal, financial, or medical advice. It reflects news and analysis, not professional counsel. Regulatory references and anecdotal industry examples are provided as context and should not be interpreted as guidance or advice for investment, legal, or financial decisions. Always consult qualified professionals for advice tailored to your situation. Video tags: finance, stock market, fintech, corporate treasury, cash flow management, enterprise risk management, financial risk, B2B payments,